For many, December is a time to reflect on the past year and to look forward to what the new year may bring. I believe organizations should mark milestones, take stock of what has been done and what needs to be done, and adjust course accordingly. My colleagues at the Commission and I go through this exercise relatively frequently, including to fulfill statutory reporting requirements. Yes, like the public companies we regulate, we too have disclosure obligations. It may make some of you happy to know that we have to eat at least a bit of our own cooking. In the past few months, we published a new 4-year strategic plan and our annual report for 2018. We also participate in the annual report process for the Financial Stability Oversight Board and the Financial Stability Oversight Council, or FSOC. In addition, our divisions and offices undertake similar reviews, and in some cases, notably our Division of Enforcement and our Office of Compliance, Inspections, and Examinations, publish an annual report or an annual list of exam priorities. Today, I'm going to go through this review exercise with respect to our rulemaking efforts. I will review our progress on the agenda we set for fiscal year 2018 and then discuss our agenda for fiscal year 2019. I'll then close with observations on certain of the key risks we are monitoring, namely Brexit, Libor transition, and cybersecurity risks. So on to 2018 agenda. We're required to publish a regulatory agenda on a semi-annual basis. 1 year ago, I spoke about my perspective on this process, including the observations that the near-term portion of what we call the Reg Flex agenda, in essence, the rulemakings that we expect to complete in the coming year, had become too aspirational. We completed about 1/3 of the items that we put on that agenda. I believe this aspirational approach was driven in large part by the more than 80 rulemakings and the more than 30 reports and studies that Dodd-Frank required the SEC to complete. I want to thank my predecessors for tackling the lion's share of those. And since they did, we recognized the opportunity to recalibrate, and our 2018 Reg Flex agenda was more focused in the past. This change was made to increase transparency and accountability, as well as to provide greater clarity to our dedicated staff. The 2018 agenda embodied a collective effort benefiting from the input of my fellow commissioners, our division and office heads, and many members of our staff. The key questions that we asked ourselves were, 1, what initiatives our agency could reasonably expect to complete over the next 12 months? And 2, of those initiatives, which ones would have the most positive impact on our Main Street investors? This exercise produced a tailored yet ambitious list of 26 different initiatives covering a broad array of topics. During the last year, the Commission advanced 23 of those 26 rules, a good result on both a percentage, 88%, and an absolute basis. In addition, the Commission responded to major events and changes in the broader regulatory landscape by advancing several other initiatives not on the original agenda. I'll deviate here. At the back of our online remarks, there's a list of the items, 26 of them, and strike-throughs on the 23. And it makes me very happy to look at that list. Other things we did, in addition to the items on that list, were issuing guidance to public companies about the disclosures of cybersecurity risks and incidents, and responded to a new congressional mandate by expanding key registration exemption used for people. Let me say it in plain English. The key registration exemption designed to deal with the fact that employees now move around a lot. Our registration exemption, to make it easier to give employees securities, was based on employees being sticky to the workplace. That's not a reality. We're trying to address that. And we also provided relief for those affected by Hurricane Florence. To be sure, statistics like 88% rarely tell more than a narrow story. What story is really important to us? It would be the same story that Main Street investors would want to know. We should assess our work not by numbers or percentage of rules and initiatives completed, but rather whether they substantively affect our Main Street investors. With this metric, the interest of our long-term Main Street investors in mind, I will discuss a few examples of our 2018 work. In April, the Commission proposed for public comment a collection of rules and interpretations applicable to investment professionals, both broker-dealers and investment advisors. These proposals, individually and collectively, are designed to enhance retail investor protection and decision-making by elevating the broker-dealer standard of conduct and reaffirming, and in some cases, clarifying the fiduciary standard for investment advisors, as well as requiring more candid and plain language disclosures. Using my plain language, we are bringing the regulation of conduct and communications in line with the reasonable expectations of our Main Street investors. More specifically, these proposed rules seek to accomplish three things. First, require broker-dealers to act in the best interest of their retail customers by expressly requiring that investment professionals not place their interests ahead of the interest of their clients. Second, reaffirming and in some cases clarifying the fiduciary duty owed by investment advisors to their clients. And third, requiring both broker-dealers and investment advisors to state clearly the most important facts about the relationship, including the financial incentives that they have. Deviate again. When you deal with somebody, you want to know how they make their money. And when you give them your money, you want to know how much of your money is going to work for you. Those are the principal, simple questions. Importantly, the proposed rules are designed to preserve retail investor access in terms of choice and cost to a variety of types of investment services and investment products, while giving investors the tools to select the type of relationship that is appropriate for their needs and in line with their expectations. This rulemaking is very important and long overdue. Broker-dealers and investment advisors both provide investment advice to their customers, but have different relationships and are subject to various different regulatory regimes. However, many retail investors do not have a firm grasp on the important differences between broker-dealers and investment advisors, including 1, differences in the variety of services they offer, 2, how investors pay for those services, and 3, the regulatory frameworks that govern their relationship. This is a complex set of issues, there's no doubt, but access to investment advice is increasingly important to our society. We also must recognize that while the current framework needs improvement, the current framework is extensive and in many areas functions well for our Main Street investors, particularly as compared to other jurisdictions. I'll come back to this when I speak about 2019. Second, in 2018, capital formation. We took several meaningful steps throughout 2018 to help companies, including small companies, participate in our capital markets, while maintaining or improving important investor protections. For example, the Commission expanded the definition of smaller reporting company. The amended definition will allow nearly 1,000 additional companies to take advantage of scaled disclosure requirements, reflecting the principle that a one-size regulatory structure does not fit all public companies. The Commission also adopted final rules that eliminate requirements that are outdated, overlapping, or duplicative of other Commission rules or US GAAP. Again, deviating, you shouldn't have to tell us the same information 4 times. Once or twice is probably enough. These amendments will reduce costs for companies. Importantly, they will not adversely affect the availability of material information, and in many cases, they will enhance the quality of information available to investors. Combined, our capital formation initiatives make the option for issuers to join our public markets more attractive, ultimately to the benefit of Main Street investors, many of whom are searching for additional investment options. We've also been monitoring our markets and market structure to evaluate whether they are meeting the needs of our Main Street investors. For example, I've long believed that there should be greater regulatory focus on our fixed income markets, particularly the corporate and municipal bond markets. These markets are particularly significant for our retail investors as well as American companies and our national infrastructure. To facilitate that effort, we stood up the Commission's Fixed Income Market Structure Advisory Committee, or FIMSAC, adding another acronym to Washington. As many people call it, the FIMSAC is made up of a diverse group of experts from across the country. They had a highly productive first year. The committee held 4 insightful public meetings and has already provided the Commission with 5 thoughtful recommendations on ways to improve our fixed income markets. I look forward to an equally successful second year for the FIMSAC. We're focusing on other aspects of our securities markets. Our Division of Trading and Markets held 3 roundtables this year to explore key markets issues. Notably, 1, the market structure for securities of smaller, more thinly traded companies. 2, regulatory approaches to combating retail fraud. And 3, access to markets and market data. The roundtables were candid and constructive, and staff in our Division of Trading and Markets is analyzing the issues raised at these roundtables. Speaking of our markets, we know that transparency is a bedrock of healthy and vibrant markets. I'm pleased to report that we have taken significant steps to make our markets more transparent. For example, in July, we adopted amendments that enhance the transparency requirements governing alternative trading systems, commonly known as ATSs. These amendments provide investors, brokers, and other market participants, and the Commission, with increased visibility into the operations of these important marketplaces for equity trading. The amendments are a credit to our staff's careful attention to market developments. Our staff recognizes that since markets are constantly changing, we must regularly and critically evaluate our approach to regulation. So now turning to 2019. Whatever our accomplishments in the past year, our work is far, far from complete. That reality comes with the territory, and the territory of ever-changing capital markets. The near-term agenda for completion in 2019 is now publicly available, and continuing with the themes of transparency, accountability, and clarity of mission, the 2019 Reg Flex agenda focuses on the initiatives we reasonably expect to complete. I hope I have a similar black line with 80% or more strike-throughs to hold up a year from now. Let me now discuss a few priority items for 2019. We want to complete our rules relating to the standards of conduct for financial professionals. That way I'll have to stop saying it. Since April 2018, we have engaged with Main Street investors across the United States to discuss their experiences. Now, we've actually gone out, I'm deviating again, we've gone out and held a number of roundtables, town hall sessions, and said, what do you like and what do you dislike about dealing with your investment advisor or broker-dealer? And what do you know about how they get paid and what their incentives are? And we learned a lot. These 7 roundtables, they provided investors with an opportunity to directly with me and my fellow commissioners and senior SEC staff, all to improve our proposals. It was clear, based on these discussions, that we do have the right perspective, namely that the core obligations of investment professionals and their mandatory disclosures should match investor expectations. It's what we keep going back to. What would an ordinary person expect to be told, and how would they expect to be treated? The efforts of the staff in this area to deliver for Main Street investors have been exemplary. In addition to the roundtables I spoke about, we launched a new webpage where investors can view samples of the proposed disclosure forms and submit feedback. Our Office of the Investor Advocate engaged the RAND Corporation to conduct investor testing of the proposed disclosure form and has made the report available for public comment. Our staff has been carefully reviewing all of the information and the more than 6,000 comment letters that we've received as they work diligently to develop a final recommendation to the Commission. I look forward to this. And just to be clear, this is, absent some event, this is my #1 priority. Turning to another important area, the proxy process. Another significant initiative for 2019 is improving our proxy process. Last month, we held a proxy roundtable to discuss 1, the proxy solicitation and voting process, 2, shareholder engagement through the shareholder proposal process, and 3, the role of proxy advisory firms. I was pleased with the solutions-oriented approach to this event of virtually all participants. We had a diverse group of panelists representing the views of investors, companies, and other market participants. And while we heard a wide range of views, we saw more agreement than disagreement, and I believe that we should act to improve each of these 3 areas. There was consensus among the panelists that the proxy plumbing needs a major overhaul. I encourage market participants to explore what such an overhaul would entail and to consider how technology, including distributed ledger technology, could improve our proxy plumbing. I realize that a major overhaul could take time. So I also believe we should focus on what the Commission can do in the interim to improve our current system. Our comment box for the roundtable remains open, and I encourage all of those interested in improving the proxy plumbing to share their thoughts, particularly regarding actionable interim improvements. I also believe it is clear that we should consider reviewing the ownership and resubmission thresholds for shareholder proposals. The current $2,000 ownership threshold was adopted 20 years ago in 1998. The resubmission thresholds have been in place since 1954. A lot has changed since then. We need to be mindful of these changes and make sure our approach to the very important issue of shareholder engagement reflects the realities of today's markets and today's investors. As I've said before, when looking at the ownership and resubmission thresholds, we need to consider the interests of the long-term retail investors who invest directly in our public companies and indirectly through mutual funds, ETFs, and other products. With these long-term retail investors in mind, we also should consider whether there are other factors, in addition to the amount invested and the length of time shares have been held, that reasonably demonstrate that the proposing shareholders' interests are aligned with those of a company's long-term investors. That is the person making the proposal, are there incentives in line with the long-term holders of that company? For proxy advisory firms, I believe there's growing agreement that some changes are warranted. There should be greater clarity regarding the division of labor, responsibility, and authority between proxy advisors and the investment advisors they serve. Everybody know what proxy advisors and investment advisor is the one who chooses what investments to make on behalf of a mutual fund, for example. And some occasions, that investment advisor contracts with a proxy advisor to crunch data and provide other information to inform the investment advisor's voting and other decisions. We need clarity, to say it again, regarding the division of labor, responsibility, and authority between those two parties. We also need clarity regarding the analytical and decision-making processes that advisors employ, including the extent to which those analytics are company or industry specific. On this last point, it is clear to me that some matters put to a shareholder vote can only be analyzed effectively on a company-specific basis, as opposed to applying a more general market or industry-wide policy. Finally, there were other issues raised at the roundtable that we should consider, including, 1, the framework for addressing conflicts of interest at proxy advisory firms, and 2, ensuring that investors have effective access to issuer responses to information that proxy advisory firms publish. So, when a proxy advisory firm makes a recommendation and the issuer disagrees with it, and it's on a material subject, an investor ought to be able to easily access both points of view so that the investor can make an informed decision. The staff is looking at these and other issues and I've asked them to formulate recommendations for the Commission's consideration. On timing, which is what people always ask me about initiatives, it is clear to me that these issues will not improve on their own with time, and I intend to move forward with the staff recommendations, prioritizing those initiatives that are most likely to improve our market for our long-term Main Street investors. Main Street investors, now more than ever, are responsible for saving for retirement. Earlier this year, staff in our Office of Investor Education and Advocacy issued a bulletin to warn investors of risks associated with self-directed individual retirement accounts, or IRAs. With the shift away from traditional defined benefit pension plans, American workers are increasingly having to rely primarily on defined contribution plans, such as 401ks and IRAs, to save for retirement. We owe it to these investors to make sure they have access to a broad mix of investment opportunities to save for retirement and to achieve other financial goals. Accordingly, in 2019, we're also looking at initiatives to facilitate access to capital for issuers and to make sure our Main Street investors have the best possible mix of investment opportunities. Several of these initiatives parallel congressional legislation that received substantial bipartisan support. For example, the so-called Jobs Act 3.0 includes provisions to expand testing the waters and to study our quarterly earnings reporting regime. Both of these initiatives are included in our 2019 rulemaking agenda. To explore further whether we can improve the mix of investment opportunities for Main Street investors, our Division of Corporation Finance is looking at the private offering framework as well. The lawyers in the audience know that our patchwork private offering system is very complex, and I believe it is time to take a critical look and see how it can be improved, harmonized, and streamlined. The staff is working on a concept release to solicit input about key topics, including whether our accredited investor definition is the principal threshold for participation in private offerings, is appropriately tailored to address for both investment opportunity and investor protection concerns. It's another definition that hasn't been substantially revised in a long time. I'll turn to encouraging long-term investment. I also believe it's important to consider ways to encourage long-term investment in our country. There is an ongoing debate regarding the adequacy and appropriateness of mandated quarterly reporting and the prevalence of optional quarterly guidance, and whether our reporting system more generally drives an overly short-term focus. I encourage all market participants to share their views and to let us know if there are other aspects of our regulations that drive short-termism. Turning to distributed ledger technology, digital assets, and ICOs. This is another area where the staff and I spent a significant amount of time. I expect this trend will continue in 2019. A number of concerns have been raised regarding the digital assets and ICO markets, including that as they currently operate, there is substantially less investor protection than in our traditional equities and fixed income markets, and correspondingly greater opportunities for fraud and manipulation. To be clear, I believe that ICOs can be effective ways for entrepreneurs and others to raise capital. However, the novel technological nature of an ICO offering does not change the fundamental point that when a security is being offered, our securities laws must be followed. In an effort to centralize and better coordinate our work on these important issues, the SEC recently announced the formation of a new strategic hub for innovation and financial technology. We call it FinHub. Staffed by representatives from across the Commission, the FinHub serves as a public resource for fintech-related issues at the SEC. As the FinHub and our other activities demonstrate, our door remains open to those who seek to innovate and raise capital in accordance with the law. So that's a picture of what happened in 2018, where we're going in 2019, and now I'm going to discuss a few market risks. And I'm happy to take questions on these during the Q&A time. So the three risks that I think we're monitoring that at the moment pose the greatest potential significance to our Main Street investors are the impact to reporting companies and other aspects of our market from the United Kingdom's exit from the European Union or Brexit. Second, the transition away from Libor as a reference rate for financial contracts. And three, cybersecurity. So let me talk about Brexit. The potential effects of Brexit on U.S. investors and securities markets, and on global financial markets more broadly, is a matter of increased focus for me and many of my colleagues at the Commission. To be direct, and I don't know if I want to be correct, but to be direct, I'm concerned about five things. First, that the potential adverse effects of Brexit are not well understood, and in areas where they are understood, they are underestimated. Second, the actual effects of Brexit will depend on many factors, some of which may prove beyond the control of UK and EU authorities. Third, our markets at many levels, from multinational companies to key market infrastructures to investment products and services, are international. And the effects of Brexit will be international, including on US markets and our Main Street investors. The question is just, how big will those impacts be? Fourth, the actual effects of Brexit are likely to manifest themselves in advance of implementation dates, and based on corporate disclosures that we've seen, some of those effects are already upon us. I'm going to deviate here. When you're managing an enterprise, you have a mindset. And I'll use trader speak, risk off or risk on. When you're more worried about the future, you go risk off. You invest less in your business. You hire less people. When you're more confident about where the world is going, you go risk on. You're willing to invest in a new plant. You're willing to hire new people. Looking at corporate disclosures already, we're seeing people go risk off with respect to the UK and Europe because they don't know where it's going. Those effects can have ripple effects. So fifth, the actual effects of Brexit will depend in large part on the ability of the UK, EU, and EU member states and the officials there to provide a path forward that allows for adjustment without undue uncertainty, disruption, and cost. This is a tall order that I believe requires a broad understanding of market interdependencies, knowledge that goes well beyond just looking at our labor and financial markets, foresight, as I just stated, people and firms will act in their own interests and the interests of their shareholders. Trying to predict what people acting in their own interests throughout an economy will do is not easy. Last, flexibility. Miscalculations are inevitable and will need to be addressed promptly. More generally speaking, limiting the adverse effects of Brexit requires a willingness of governmental authorities to look beyond potential immediate local economic and other opportunities that may be provided by a blunt transition and pursue a course that focuses on broad, long-term economic performance and stability. While many involved in the Brexit process agree with this perspective, and some important steps with this perspective have been taken, I do not yet see wide acceptance of this principle. To be clear, these are my personal views, but it's appropriate to share them as they are reflective of our approach at the SEC to Brexit. The SEC's responsibility is primarily related to the effects of Brexit on our capital markets. And for example, I've directed our staff to focus on the disclosures companies make about Brexit and the functioning of our market utilities and other infrastructure. We've seen a wide range of disclosures, even within the same industry. Some companies have fairly detailed disclosures about how Brexit may impact them, while others simply state that Brexit presents a risk. I would like to see companies providing more robust disclosure. With regard to market utilities and infrastructure, Following the 2016 Brexit vote, we commenced discussions with other U.S. financial authorities and our UK and EU counterparts, all with an eye toward identifying and planning for Brexit-related impacts on U.S. investors and markets. These discussions are ongoing, and I expect their pace to increase. The second risk that I want to highlight relates to the transition from Libor, a benchmark reference rate for short-term interest rates. Libor is used extensively in the U.S. and globally as a benchmark for various commercial and financial contracts, including interest rate swaps and other derivatives, as well as floating rate mortgages and corporate debt. It is likely, though, that the banks currently reporting Libor, or the information, or more accurately, the information required to calculate Libor, will stop doing so after 2021. The Federal Reserve estimates that in the cash and derivatives markets, there are approximately 200 trillion, that's trillion with a T, in notional amount of transactions that reference US dollar Libor. And that of those, more than 35 trillion will not mature by the end of 2021. The Alternative Reference Rate Committee, a committee convened by the Federal Reserve that includes major market participants and on which the FCC staff and other U.S. regulators participate, has proposed an alternative rate to replace US dollar Libor, SOFR, the Secured Overnight Funding Rate. The committee has identified benefits to using SOFR as an alternative to Libor. For example, SOFR is based on direct observable transactions, and SOFR is based on a market with very deep liquidity, reflecting overnight Treasury repurchase agreement transactions with daily volumes regularly in excess of 700 billion. Let me just say this, for those of you who don't know, before Jay Powell became chairman of the Fed, one of his principal responsibilities as a governor was working on SOFR. He did a fabulous job. A significant risk for many market participants in this area is whether public companies who have floating rate obligations tied to Libor, or broker-dealers, investment companies or investment advisors that have exposure to Libor, is how do we manage the transition from Libor to a new rate such as SOFR, particularly with respect to those existing contracts that will still be outstanding after 2021. Accordingly, although this is a risk that we are monitoring with our colleagues at the Federal Reserve and the Treasury Department and other regulators, it is important that market participants, let me say this again, it's important that market participants act appropriately. We can't do it for them. What we can do is help provide an alternative reference rate, help the market function well, but as far as bilateral contracts and other things, the market needs to get to work. For example, if a market participant manages a portfolio of floating rate notes based on Libor, what happens to the interest rates of these instruments if Libor stops being published? What does the documentation provide? Does fallback language exist? And if it exists, does it work correctly in such a situation? If not, will consents be needed to amend the documentation? I know from 25 years of experience that consents can be difficult and costly to obtain, with the costs and difficulty of attaining those consents generally correlated with uncertainty. In the area of uncertainties, we continue to monitor the risks related to the differences in the structure of SOFR and the differences in structure of SOFR on the one hand and Libor on the other. SOFR is an overnight rate, and more work needs to be done to develop a SOFR term structure that will facilitate the transition from term-based Libor rates. SOFR is a one-day rate. Many of the contracts that reference Libor say, what's the 30-day rate? So we have to extend the SOFR market to capture 30, 60, and 90-day rates. A lot of progress has been made, but more work needs to be done. So now turning to the last risk and today's topic, cybersecurity. Cybersecurity is something that we at the agency look at from a number of perspectives. From an issuer disclosure perspective, it is important that investors are sufficiently informed about the material cybersecurity risks and incidents affecting the companies in which they invest, both the risks and the incidents. Earlier this year, the Commission issued interpretive guidance to assist public companies in preparing these types of disclosures. The guidance emphasizes the importance of disclosure controls and procedures that will enable public companies to make accurate and timely disclosures about risks and events, as well as policies that protect against corporate insiders trading in advance of company disclosures of such events. From a market oversight perspective, we continue to prioritize cybersecurity in our examinations of market participants, including broker-dealers, investment advisors, and critical market infrastructure utilities. In assessing how firms, 1, prepare for a cybersecurity threat, 2, safeguard customer information, and 3, detect red flags for potential identity theft, we have focused on areas including risk governance, access controls, data loss prevention, vendor management and training, and many others. We are focused on assessing and improving our own cybersecurity risk profile. Again, trying to eat a bit of our own cooking. We now have a chief risk officer to help coordinate our risk management efforts across the agency. We've worked to promote a culture that emphasizes the importance of data security throughout our divisions and offices. Our staff has also been working with outside experts to assess and improve our security controls. We recognize, however, that no system can be entirely safe from cyber intrusion and that a lot of work remains to be done. From an enforcement perspective, our cyber unit is dedicated to targeting cyber-related misconduct in our markets. Among other things, in addition to looking at potential violations in some of the areas I just described, the cyber unit has focused on alleged misconduct involving intrusions into retail brokerage accounts, the submission of false regulatory filings, and hacking to obtain material non-public information. And finally, from an investor education perspective, our Office of Investor Education and Advocacy has worked hard to inform investors about cybersecurity hygiene and red flags of cyber fraud in order to prevent investors from becoming victims in the first place. These are just some of the areas we're looking at, and I look forward to discussing them further with today's distinguished panel members. To conclude, I'm very pleased with everything that our tremendous staff was able to accomplish in 2018. But much remains to be done, and we are facing new challenges, some known and some that we will come to know. That is why our 2019 agenda is ambitious yet pragmatic, and it leaves room for those issues that we have not yet anticipated. Thank you for the invitation to speak, and I look forward to our discussion.